How to grow your wealth through tax planning. Why did you start your own business? If you own your own business and have been running it for a while, you will agree that running your own business is not an easy thing to do. So why did you start your own business? Because you believe that running your own business will get you closer to achieving your dream. If you own a profitable business and have been running it for quite some time, you will agree that your tax bill is probably always the largest expense in your business. Hence, when searching for a CPA to work with, most business owners have the expectation that their CPA should help them reduce their tax burden. The problem here is that many business owners fail to realize that tax preparation is not tax planning. Tax preparation happens after the fact. It happens after the tax year, which ends on December 31st of every calendar year. If your expectation is that a CPA should be able to apply some magic wand to reduce your tax bills after December 31st, you are most likely missing out on lots of opportunities to greatly reduce your taxes. To reduce your tax burden effectively, you need proper tax planning. Most of the time, business owners perceive tax planning as merely implementing a few tips to cut their tax bills. The reality is that successful tax planning requires careful and strategic planning and execution, just like the approach you have taken to start, grow, and maintain your business. Why tax planning? Tax planning is important for every business because proper tax planning encourages tax avoidance, legally. Tax Planning 360, the XQ CPA methodology. The journey of tax planning begins with you understanding your tax position and then identifying the right strategies that are most effective for you and your business. To practice implementing effective tax strategies, you need to know how to apply them. Step 1. Generate accurate financial statements. To develop a relevant and effective plan, as a business owner, you must know your numbers. Your financial statements need to be completed accurately because without understanding your financial performance, i.e., your taxable profit for the year, any tax planning efforts are in vain. Step 2. Understand your tax position. For every taxable profit you have earned, what is your tax bracket? And what is your effective tax rate? Step 3. Determine your desired tax position. If you have made a $100,000 profit, how much are you willing to give away to the IRS? What would you need to give to the IRS without tax planning? Step 4. Maximize your deductions. There are many kinds of deductions that are eligible for businesses. Whether the deductions require an actual cash outlay or not, do you have the right system to capture all these deductions? Step 5. Income shifting. Are you operating under the right entity structure? Are you missing out on any opportunities to shift your taxable income to a lower bracket? How do you do that legally without triggering an IRS audit? Step 6. Deferrals. Do you have the right account set up for your retirement savings? Does your current setup allow you to defer most of your taxable income until your retirement age? Step 7. Strategy evaluation. You may have a great plan, but business is ever changing. Do you have a system in place where you are able to evaluate your tax strategies on a regular basis? Step 8. Close the gap. With all the tax strategies you have implemented, do you have adequate supporting documentation to substantiate your deductions before you claim them as deductions on your tax return? Step 9. Final tax balance determination. What is your tax goal for the year? What did you initially anticipate to be your tax balance? Have you paid it by the estimated due dates? Are there any additional actions you need to take to achieve your desired tax position? If you want to be proactive in reducing your tax bills, have the following in mind. 1. A proper tax plan. Just like creating your business with clear goals and intention, when it comes to tax planning, you will never be successful if you do not have a proper plan with clear goals of exactly how much you are willing to pay to the IRS. 2. An accurate tracking system. Tax planning is pointless if you do not have a proper accounting system in place to track and monitor all actions taken for your business. Tax planning is only meaningful if you know your numbers, understand your tax bracket, have a goal of where you want to be, how much tax you really want to pay, and how much effort you are willing to put in. Tax planning is a lifestyle.